Welcome back to the Teaching Tax Dlow podcast, everybody, here at the Strategic Associates Studio. This week, we're going to dive into, on episode 199, that's right, we're one away from 200. We are going to carry out our conversation that we had last week as we look at W-2 earners, but this time, those making over $600,000 a year or more. So last week, we looked at $100,000 or less. This week, $600,000 or more. Might be wondering why there's a gap in there. However, we're going to dive into that a little bit, but more importantly, those that are in that 600 plus, you're going to walk away with some great stuff here. So as always, Chris Picciurro, welcome back to your own show, sir. Let's dive into it, brother.
Thank you, and excited to be back. The $600,000 or more wage earning families. For purposes of this podcast, we're going to assume that that the person or the taxpayer does not own a business, or their spouse does not own a business or rental properties at this time, which I know we spoke about last episode. Is the vast majority of taxpayers are W-2 wage earners primarily. And in the Teaching Tax Dlow community, we know that your tax bracket lies to you. Marginal tax rate is what's important. And for people that are over $600,000, if they're a single filer or they're a married filing joint, typically they're going to be in the 35% or higher marginal tax rate on the federal return plus state. So we are talking, they could be well into the 40%. So they're giving their business partners, involuntary business partners, 40% of their earnings if they don't do anything. So what do we do? What are my top 5 strategies for these type of taxpayers? So yeah,
And that
absolutely.
involuntary business partner, right? That's the IRS. We
The
don't want to forget
IRS
about that.
or your state, or if you're lucky enough to live in the city of Detroit, the city of New York, city of Grand Rapids, Michigan, et cetera, et cetera. There are some cities that they want a piece of the pie also. So what do? Right? You've done well for yourself. And unfortunately, all the credits we talked about last episode, child tax credits, all the Schedule 1A deductions, right? That overtime, the tips, the senior deduction, the interest on the new vehicle, they're gone. You're not eligible for that. And another issue with the One Big Beautiful Bill Act is we're all celebrating that the SALT tax deduction, state and local income tax deduction, went from $10,000 max for married joint to $40,000. However, at $500,000 of income, of adjusted gross income, guess what happens? It starts to phase out. So for these people, they are really getting phased out of almost every deduction and credit available. So how do we fight back, right?
And when we dive into this, Chris, I would wager a bet too. Like the last time, we were talking to those making 100,000 or less. That one was more or less introducing things to them. They might not have even taken advantage of tax planning. Majority 600 plus probably have in some regard, whether they know it or not. So these, and honestly, everybody that's listening, I don't know what he's going to say for these, to be totally transparent. So I could be wrong. Most of these or all of these, is this something that they're going to want to really engage their tax professional on for the
Right.
most part? Okay.
Absolutely. Most of these folk, but you'd be surprised sometimes, most of the people in this situation have begun to build out what we call your personal board of directors. So that's at this point. And if you haven't, and if you're interested, just let us know if you need help with something. Jumping into Feeding Taxes, our private Facebook group. We'll leave a comment on this on our YouTube videos where we will reply. So, okay, what should you do? First thing you want to do is understand that your main goal is to take any expenses that you have that ultimately you're paying after tax. You're paying a 40% premium on, and make them tax deductible or pre-tax. So that starts with taking advantage of any type of employer provided benefits. So that means retirement plan contributions. So I'm very much pro tax-free income and growth, but if you're paying a 40% tax, red diagnosis, most likely it would make sense to go pre-tax with much of your retirement plan contributions. Also, things like your dependent care benefit, load that up for $5,000. So those are called Section 125 plan opportunities. So anything that you're going to pay that you can do with your employer pre-tax, deeply consider doing it. like the two main ones are going to be retirement plan and dependent care. So that's number one. So definitely look at your HR, look at these things and try to go pre-tax with as much as you can with your compensation. Number two, and this was the only common denominator between the under 100 crowd and the over 600 crowd. My TriStar, because I'm a proud resident of the state of Tennessee, tax planning implementation. You probably know what it is now, John, don't you?
Oh, I know exactly where you're going with this one. I see it.
What is it?
We are going to talk about the HSA, most
Yes.
likely the health savings account, and why you need to. No, I'm just kidding. You don't want to hear me talk about this, Chris. You give them the explanation. It's a powerful little beast, though. Let's be honest.
Absolutely. Yep. It's great. So the health savings account, you're
Mhm.
going to get a tax deduction for whatever you put into it today. The money's going to go tax free or tax deferred, and then you're going to take it out tax free down the road. So any medical expenses you have, if your W-2 wages are over 600,000, you're most likely not getting a deduction for. Why? Well, you might be itemizing your deduction, but only the amount of medical expenses that exceeds 7.5% of your income are deductible on the federal return. So just put the money in your HSA.
And Chris, it
Even if you don't
amazes
need it
me.
now.
Exactly, and I would say it really does amaze me. And again, I am not the tax pro here. I'm above a novice. Let's be honest. I'm
Yeah,
mediocre.
you've grown a lot.
We got to think of a term for what I am because I'm above the middle, but I'm now obviously where you guys are at. It really is amazing. Even friends that I have, business owners, higher incomers on W-2s, I mean, they're into some of them over $1 million a year, and they still did not know about an HSA. You talk about me feeling like I really know what I'm talking about. Here I am introducing something to them as simple as what that is. Uh, so it is interesting. Even my wife, even on her, when they switch benefits packages, it's kind of hidden in their HR packets. It's not really something that's out there. So, like you mentioned, leaning on an HR department and knowing kind of what you're asking for, like what we're talking about here, is super powerful. It's a heck of a resource, right?
And so I would consider you tax professional adjacent.
Oh,
You're on this. Yeah,
yeah.
you're close.
Yeah. You mean to tell me if I hang around a football field long enough, but can't play that no, we're not going to go down that route.
Kind of like, in the South here, they call it caddy corner, but we know it's your kitty corner from a tax pro. You're right there.
There we go. That's
So
my new title I'm giving myself.
my third one is going to be this concept of bunching itemized deductions. Now, usually bunching is bad, right? It could be an undergarment or something uncomfortable. So, but bunching itemized deductions could be a really good strategy. What does that mean? That means that with the larger standard deduction, a lot of times some of your taxes or charitable contributions or medical expenses, if you spread them out over 2 years, if you then you don't get as much of a tax benefit. And maybe you're right on the fringe of taking the standard deduction. But if you bunch them, maybe you basically load them up on even years and don't pay as many on odd years, then you get a better tax benefit. So it's a concept of bunching itemized deductions. And for people in this situation where you might be taking the standard deduction, you're barely over the standard deduction, you're better off bunching the deductions and moving some expenses, from one year to the other. And then, so we know a lot of people that, for instance, property taxes or charitable contributions, they will intentionally load up one year and pay less the next year.
That makes
And
sense.
it's same with medical expenses. Although you definitely want to use HSA first. So that's my number 3. Number 4 is going to be advanced giving strategies. So obviously people tithe, people give. That's an itemized deduction. If you do, in fact, itemize your deductions, but for people in this income threshold, they probably want to be more advanced with their strategies. The advanced strategies that we come across most often, there are 3, and we have additional content on this, but I'm going to mention them. The use of private foundations for some families, it can be very powerful. The use of DAF sounds bad, doesn't it? Sounds like a bureau of the government, federal.
Department of Federal Auditing? No, or
It's
Department of
donor.
Auditing. Yeah.
Using donor advised funds is another charitable contribution. It's kind of like bunching, but it's another advanced charitable contribution strategy. So when I say advanced, like, you know, again, sometimes you just donate as you in a normal situation or tithe. These are specific things you could do to maximize your donation deduction. So you've got private foundations, donor advised funds, and then leveraged giving opportunities. Leveraged charitable giving, which is a tax mitigation strategy. We have a whole podcast episode just on that topic. So especially if you are in a state that allows for itemized deductions and allows for charitable contributions, doing some advanced giving makes a lot of sense. So think about that. My number 5 is the use of bonus depreciation. And you might say, well, how do I have bonus depreciation if I'm a W-2 wage earner? You're right. You don't. But if you're in this situation, if you're in good for you, like congratulations, you're doing well. You have over $600,000 of the W-2 wages. You might want to consider opportunities where you could take advantage of bonus depreciation. Now, be very careful, right? Because you have to be aware of, so just going and buying a piece of equipment or going and entering into a syndication where you're own a portion of an apartment building or a mobile home park or a multifamily doesn't necessarily allow you to offset your W-2 wages with bonus depreciation. You might receive what's called a K-1 with bonus depreciation on it, but you're not offsetting your W-2 wages. So you have to make sure that if you're going to take advantage of bonus depreciation, you are qualifying for non-passive treatment of whatever business activity you consider getting into. And there are common bonus depreciation strategies. Again, we're not saying go buy a short-term rental property just to get the bonus depreciation, but many people get involved in the short-term rental market, buy a short-term rental property and take advantage of bonus depreciation. Many people get involved with housing of different types, equipment leasing, and that sort of stuff. So there are opportunities out there for people. There are other investments in like the oil and gas space or the wildlife space. So we are not advocating you jump into any type of investment at this point. But what we are saying is, as a W-2 wage earner, there are opportunities with not having to put forth ridiculous amounts of hours to meet what we call that material participation threshold. By the way, there's more content on that.
This podcast is sponsored by Reps Tracker. Are you a real estate investor who is bogged down with the huge tax burden? Real estate investing can open the door to powerful tax benefits. Reps Tracker can streamline the process of accelerating these opportunities. To take advantage of a special TTF community discount, go to teachingtaxflow.com/reps, REPS, and use the code IFG. Better yet, click on the link below in this episode's show notes to go directly to the Reps Tracker sign-up page.
To take advantage of bonus depreciation through investments that are outside of your normal 401k or brokerage account. And but those are out there. And those are the things that W-2 wage earners are doing, but we have to do it the right way. Remember, ideas are cheap, implementation is valuable. So if you have questions, comments, please leave a comment in the YouTube, on the YouTube video here, or Defeating Taxes private Facebook group. We are happy to help guide you in the right direction. But many, many W-2 wage earners are taking advantage of bonus depreciation. And the good thing is if you're married, if your spouse meets the material participation threshold and can take bonus depreciation, a spouse can offset not the breadwinner, but the higher W-2 wage earning spouse. This is W-2. So
no,
those
these
are my
are
top 5. So we got, those are my top 5. We've got the pre-tax employee benefits. We've got the house savings account. We've got bunching of itemized deductions, advanced charitable giving, and bonus depreciation.
Awesome. And Chris, those were good ones. And now you know that we've identified that I am tax professional adjacent. I feel like I know more about this. And going back to what I asked really at the beginning, right, is are these something that really somebody needs to engage a tax pro specifically on? I think you answered it yes, just by really wrapping up, even especially with number 5. I think that last one was super important. And, for somebody, again, that maybe has never even taken advantage or taken any advantage of tax planning or talking to a tax pro, or maybe you have one and, not, to talk down on anybody, maybe they're not too familiar with a lot of this stuff. Think about it, and I'm just pulling this off the cusp. It's basically, imagine a sports team and then a coach, right? There's a reason that that sports team has a coach. It's somebody who's not playing the game. It's somebody that's watching it. They're forecasting plays. They're, looking back at previous plays and games, and they know what's going on, but they're not actually in it. I'm a hockey guy. Say they're not actually on the ice. Really, Chris, that's your role, and I've seen it and I've heard it. I've been in meetings. I've been in a lot of these conversations where there's almost nothing more important than somebody not being in the game, but looking at it from the outside in, because when little things are missed, big
Right.
problems could occur or big opportunities are missed. So I'm glad that you hit really all 5 of those. And that last one really brought it home. Good job.
My pleasure. And I look, and I look forward to seeing everyone in the Teaching Tax Dlow community. Thanks for watching. Let us know if you have any questions. We are here to serve you. We're here to help. And I hope everyone has a great day.
Absolutely. Well, thank you again for joining me on your show. And everybody that's watching this, again, as Chris mentioned there, check out Defeating Taxes. You can go to defeatingtaxes.com. I'll put the link in the show notes. Check it out. It opens up the floodgates to all of our resources. So there's no paywall. There's nothing in there. It's all yours for the taking. Very easy to find stuff in there too. So check it out. I said it last episode. Don't be lazy. Get on there. This is me pointing my finger as my grandmother used to do to me. Say, don't be lazy. Do it. Check it out. We'll see everybody next week here on the Teaching Tax Dlow podcast. Have a great week.
The information in this podcast is educational and general in nature. It reflects the opinions of Teaching Tax Dlow and does not take into consideration the viewer's personal circumstances. It is not intended to be a substitute for individualized financial, legal, or tax advice. Consult the appropriate qualified professional prior to making any decisions. Securities are offered and supervised through Cabin Securities Inc. member, FINRA, SIPC. Investment advisory services are offered and supervised through Cabin Advisors LLC, an SEC registered investment advisor. Chris Picciurro is a registered representative of Cabin Securities and an investment advisor representative with Cabin Advisors LLC. Teaching Tax Dlow is an independent entity and is not affiliated with Cabin Securities or Cabin Advisors.